In 2022, a retired couple in Arizona watched 63% of their life savings disappear in 11 months. Instead of betting on meme shares or trading cryptocurrencies during the day, their financial advisors built what he called a balanced portfolio: 60% stocks, 40% bonds. The textbook allocation you've seen in every retirement plan article. Since 1995, it was a complete failure. The S&P 500 fell about 19% that year. But that is the part nobody talks about. The Bloomberg US Aggregate Bond Index fell 13%. The index was supposed to serve as a safety net, ballast and protector. It was the worst year for bonds in modern American history. Stocks fall and bonds fall at the same time, which means that the so-called balanced portfolio does not provide balance at all. The couple had to sell. Now, the story isn't meant to scare you. That is because there is a huge difference between thinking you have a risk management strategy and actually having one. And most people, including those who think they have financial knowledge, are on the wrong side. Today, we will examine in detail how investment risk actually works, why traditional wisdom about asset allocation is dangerously outdated, and what the smartest fund managers on earth did in 2025 to protect principal while still producing meaningful returns. None of this is theory. That is survival. Let's get started. Most people don't lose their principal by taking too much risk. They fail because they take risks they don't understand, a distinction that is more important in finance than in any other area. In practice, what exactly does that mean when people say they have conservative portfolios? The heavily allocated bonds could be blue-chip, dividend-paying stocks and a money market fund. The word conservative is itself a comfort, like a warm blanket on a cold night. But relative to what? Relative to when? Portfolios seen as conservative in 201. The 5th of May behave like some crazy radical in 2025 because fundamentals have changed. Interest rate changes. Inflation expectations have changed. The correlation between asset classes has changed. Geopolitical risks have changed. If your framework doesn't adapt to these changes, you're not conservative. You're complacent. And the price of complacency is higher than any radical bet. Look at what happened in recent history. From 2009 to 2021, we experienced the longest bull market in American history, with 13 years of almost uninterrupted stock returns. The S&P 500 climbed from a low of around 676 in March 2009 to nearly 4,800 at the end of 2021. And the Standard recommended that it work well during that period. Continue to invest, buy at a low price, and the market time is better than the time. It works so well that an entire generation of investors internalized it as a blessing. But this proposal was born in a very special environment, one formed by falling interest rates, the Federal Reserve's large-scale quantitative easing, low inflation, and relative geopolitical stability. When these circumstances change, when the Federal Reserve starts raising interest rates aggressively in 2022, when inflation reaches 9.1%, when war breaks out in Ukraine and disrupts global energy markets, this gospel not only underperforms, but also actively destroys wealth. The people most hurt aren't the ones who know they're taking big risks. The casualties were those who thought they were safe. Therefore, before talking about any specific allocation strategy, any specific asset class, any specific fund or product, it is necessary to establish the basic principles of real risk management. Risk is the probability of permanent capital loss. adjusted for your specific time frame and specific income needs. Everything else is noise. Write it down. Because once you internalize that definition, everything about how you build your portfolio changes. Now, let's talk about the actual risks in your portfolio that may not yet be discovered. Not textbooks, but real textbooks. First, concentration. Risk is the most common killer. It also takes a form that most people don't recognize. Obviously, if you put 80% of your money into a stock, you are concentrated, and everyone knows that. But that is what we missed. You can hold 500 stocks, but still concentrate crazily. Take the S&P 500. In early 2025, the top 10 stocks account for about 35 to 37% of the total market value. Apple, Microsoft, Nvidia, Amazon Meta, Alphabet, Broadcom, Tesla, and other companies dominate the index. If you own an S&P 500 fund that happens to be the most popular single investment vehicle in the United States, more than a third of your money holds 10 companies, most of which operate in the same industry and technology. So when someone claims they are diversifying because they own a total market index fund, the real question is where to diversify. Now, the US stock market is one of the most concentrated markets since the internet bubble. If the technology sector is corrected, not a crash, but a correction, your diversified index fund will soon feel very concentrated. The second risk is interest rate risk, the risk of destroying those balanced portfolios. In 2022, when interest rates rise, bond prices fall, which is basic fixed income math. However, the speed and extent of interest rate hikes from 2022 to 2023, and the rise of the federal funds rate from close to 0 to more than 5%, are something most investors have never experienced in their lives. By early 2025, the Federal Reserve had begun to cut interest rates, but it was cautious, and we would not return to 0 soon. The era of free currency is over, which means that the bond investment rules of the past 40 years need to be thoroughly reconsidered. Duration risk. The sensitivity of bonds to changes in interest rates is something that most retail investors have never considered, and is very important. If interest rates are bad for you long-term, Treasury bonds may depreciate by 20% in a year. This is a stock-level fluctuation, which should be your safe capital. The third risk is inflation, which operates like a silent thief. You can avoid every market crash, every correction, every eye-catching disaster, but you still lose real principal. If your portfolio returns 4% a year and inflation is 3.5%, your real return is 0.5%. After tax, you may go backward, which is not an assumption. That is a reality for millions of Americans now sitting in money market funds and high-yield savings accounts who feel safe as their purchasing power slowly erodes. At the beginning of 2025, CPI overall inflation has fallen from its peak in 2022, hovering in the range of about 2.5%, 3%. But it is an average, and the average hides a lot. If you retire and your spending is skewed toward healthcare, housing, and food, all of which are inflating faster than the headline numbers, your personal inflation rate will be higher, and possibly much higher. Your portfolio needs to consider this gap. The fourth risk is liquidity risk, which no one thinks about until it is too late. Liquidity risk means you cannot sell assets when you need them, or you can only sell them at a significant discount to their actual value. This is reflected in real estate, private equity, some alternative investments, and even in times of stress. In some corners of the bond market, the collapse of Silicon Valley banks in March 2023 provides us with a textbook example. SFBB holds portfolios of long-term treasury bonds and mortgage-backed securities, which are very safe in terms of credit risk because the US government pays. But when depositors' divestments forced them to sell bonds quickly, the bank reported a loss of nearly $2 billion. The assets were safe but illiquid, a mismatch that left the bank dead within 48 hours. You may think this doesn't apply to your situation, but think about it. You also face the same risk. If a large portion of your net worth is in assets like homes, private businesses, real estate syndicates, and even early withdrawals of CDs, needing cash in a crisis, where assets can't be converted quickly, can get you into serious trouble. The fifth risk is behavioral risk, which may be the biggest risk. You are the biggest threat to your portfolio. Not the Fed, not China, not the next recession. You. Study after study from Dalbar, from Morningstar, from Vanguard reveals the same pattern. The average investor dramatically underperforms the very funds they invest in. The S&P 500 might return 10% annualized over a 20-year period, but the average equity fund investor captures somewhere around 6 to 7% over that same stretch. The reason is painfully simple. They buy high and sell low. They panic during crashes and chase performance during rallies. They make emotional decisions at the worst possible moments. $370 billion left equity funds in 2022, according to ICE data, as retail investors moved to cash and money markets. And anything that felt safe. And then, the market rallied over 24% in 2023. Many of those same investors missed the recovery because they were sitting on the sidelines, waiting for the right time to get back in. That behavioral gap, the difference between what the market returns and what investors actually capture, is a form of principal loss that never shows up in red on your brokerage statement, but it is devastatingly real. So now that we know what we're protecting against, let's talk about how to actually build a portfolio that can withstand these risks. And let me be very clear about something. There is no single allocation that works for everyone. Anyone who tells you otherwise, anyone who says just do 60-40 or just buy the S&P and hold it forever, is either lazy, uninformed, or trying to sell you something. Real asset allocation adapts. It adjusts to your age, your income, your expenses, your time horizon, your tax situation, and yes, the current macroeconomic environment. But there are frameworks that perform far better than conventional wisdom, and I want to walk through 3 of them. The first is the bucket strategy, an approach that has gained enormous traction in the financial planning community over the past decade, and for good reason. This strategy divides your portfolio into 3 distinct pools based on time horizon. Bucket 1 holds your short-term money, covering 1 to 3 years of living expenses. This goes into cash, money market funds, short-term treasuries, or short-duration, high-quality bond funds. And the purpose of this bucket is not to grow. The purpose is to exist. Think of it as your oxygen tank, the thing that allows you to breathe during a market crash without being forced to sell equities at the worst possible time. As of early 2025, money market funds and short-term treasury bills still yield in the range of 4 to 4.5%, which means your short-term bucket isn't just sitting there. It's actually earning a reasonable nominal return. While it protects you, Bucket 2 holds your medium-term money, covering the 3 to 10-year window. This is where you take moderate risk through intermediate-term bonds, dividend-paying stocks, real estate investment trusts, and possibly some balanced or multi-asset funds. The purpose is to provide income and modest growth while keeping volatility in check. Bucket 3 holds your long-term money, everything beyond the 10-year mark. This is your growth engine, allocated to domestic equities, international equities, emerging markets, and potentially some higher-risk alternative investments, because you won't need this money for a decade or more. You can afford to ride out volatility. And, in fact, you need to ride it out because this bucket has to outpace inflation over the long haul. What makes this framework so effective is the psychological protection it offers, which matters just as much as the financial structure. When the market drops 30%, and at some point it will, you look at Bucket 1 and tell yourself that you have 3 years of expenses sitting right there. You don't need to touch your stocks, and you can wait. That buffer prevents you from becoming another behavioral risk statistic. And honestly, that's worth more than any hedge fund strategy on Earth. The second framework is risk parity. The approach Ray Dalio popularized at Bridgewater Associates with his all-weather portfolio concept. The underlying idea is simple but powerful. Instead of allocating based on dollar amounts, you allocate based on risk contribution. In a traditional 60-40 portfolio, you might think 60% of your risk comes from stocks and 40% from bonds. But the math doesn't work that way. Equities run roughly 3 to 4 times more volatile than investment-grade bonds, which means 85 to 90% of your total portfolio risk actually originates from the equity side. In a 60-40 split, your bonds contribute almost nothing to balance things out. They're window dressing and nothing more. A risk parity approach equalizes the risk contribution across asset classes, which means a lower allocation to equities, a higher allocation to bonds, sometimes with borrowed capital involved, and meaningful positions in commodities and inflation-protected securities. The goal is a portfolio that performs reasonably well across 4 economic environments: rising growth, rising inflation, and falling inflation. Risk parity does have its critics, and the approach struggled in 2022, precisely because stocks and bonds fell together, breaking the historical assumption of negative correlation between those two asset classes. But over longer stretches, spanning 20, 30, or 40 years, risk parity has produced very strong risk-adjusted returns with far lower drawdowns than a traditional equity-heavy portfolio. You don't need to implement full risk parity to benefit from the thinking behind it. The takeaway for regular investors is this: think about where your risk actually comes from, not just where your dollars sit. If 90% of your portfolio's risk concentrates in one asset class, you are not diversified, no matter what your pie chart looks like. The third framework is the liability matching approach, used by pension funds and insurance companies, and incredibly powerful for retirees or near retirees. The core idea is straightforward. You identify your future liabilities, meaning the specific amounts of money you'll need at specific times, and you match them with assets that mature or pay out on schedule. As an example, if you know you'll need $50,000 a year in retirement income for the next 20 years, you can build a bond ladder using a combination of treasury bonds, TIPS, investment-grade corporates, and possibly annuities. That matures in sequence to match each year's cash need. The portion of your portfolio dedicated to these known liabilities becomes immunized from market risk. Whatever remains after your liabilities are covered can be invested more aggressively for growth, legacy, or discretionary spending. This approach eliminates the single biggest risk retirees face: sequence of returns risk. That's the danger of a major market downturn occurring early in retirement, when the portfolio sits at its largest and withdrawals exert the greatest impact. Sequence of returns risk has destroyed more retirements than any individual stock crash, because the math of withdrawing from a declining portfolio is brutally asymmetric. A 30% drop when you're 35 and still contributing to your 401k is an opportunity to buy cheap. A 30% drop when you're 67 and pulling $6,000 a month to live on is a catastrophe. Let's get specific about which assets protect principal in the current environment. One defined by rates that are elevated but declining, inflation that's moderating but sticky, equity valuations that look stretched by historical standards, and geopolitical uncertainty that shows no sign of fading. Treasury inflation-protected securities, or TIPS, deserve attention first. These are U.S. government bonds whose principal adjusts with the consumer price index, meaning that if inflation rises, your principal rises with it, and if inflation falls, you still receive at least your original face value at maturity. Real yields on TIPS, meaning the yield above inflation, sit around 1.8 to 2.2% for the 10-year maturity as of early 2025. That number is historically attractive and worth paying attention to. For most of the 2010s, real yields on TIPS ran negative, which meant you were paying the government for the privilege of lending them money. Now you're actually getting compensated for that loan. For principal protection, with a built-in inflation hedge, TIPS are about as clean as it gets. Short-duration investment grade bonds also belong in this conversation, with the yield curve still offering decent returns on the front end. Short-term corporate bonds, rated A or above, provide income with minimal interest rate risk. Duration of 1 to 3 years means your price sensitivity to rate changes stays low. You clip your coupon, you collect your principal back at maturity, and you move on. The whole thing is boring, and boring in this context is exactly what you want. On the equity side, if you need growth, but also some downside protection, look at the balance sheet fortress. Dividend aristocrats, companies that have increased dividends for 25 years or more. Johnson & Johnson, Procter & Gamble, Coca-Cola, Pepsi, and other companies will not double in a year, but it is highly unlikely